I found a very interesting business that I want to share with you in today's video. This business became public in 2013 via a spin-off and has massively and consistently outperformed the S&P 500. It has repurchased more than half of its share count since becoming a publicly traded company as well, and has compounded its cash flows at 28% annually. It's an incredible case study of a boring business that has created immense shareholder wealth. And I believe that by studying businesses like this, we can all learn how to identify high-quality, wealth-creating businesses in the future. Before we get into the video though, I want to let you all know that I will be attending the Blossom event in Toronto on June 25th. I was invited to be on two different panels at the event now, so I will be speaking around 5:30 and around 7:30, and I will also be hanging out at the event all night. So if you would like to come and meet me in person, then you can get your tickets to the event via the link in my description. And if you have a copy of my book, The Fundamentals of Investing, then make sure to bring it along, as I would love to sign your copy of my book. But with that being said, let's hop into today's video and discuss the high quality compounder that I found. Alright, so this is the stock right here. The ticker is MUSA, and the company is Murphy USA Inc. Now, if we take a look back in 2013, this was a $36 stock, and it is a $480 stock today. So it has more than 10x'd in the past about decade now. If we take a look at the percentage returns, we can see that MUSA is up 1,111% since becoming a publicly traded company. And again, it has massively outperformed the S&P 500. So what does Murphy USA do? Murphy USA is one of the largest independent retailers of gasoline products and convenience store merchandise, with more than 1,700 locations in 27 states across the Southwest, Southeast, Midwest, and Northeast United States. The company now has 1,733 locations in 27 different states and serves 2 million customers per day. So Murphy's is basically a convenience store company, and I found this stock right here because I was taking a look for alimentation competitors, because I do own ATD in my personal portfolios. So I wanted to take a look at the entire industry and find if the competitors were performing well, or if they had some sort of advantage over the stock that I actually hold. And I will be talking more about alimentation near the end of this video. But first, I do want to cover more about Murphy, or the ticker symbol MUSA here, and explain how this business has produced such incredible returns. So here we can see MUSA's flywheel, and it starts from MUSA attracting more customers, and then it makes its stores more efficient, so it basically increases its profit margins on a per store basis. Then it uses these profits to build new stores and rebuild existing stores to take more market share, and then use the profits to buy back stock and invest in more stores. This is basically the company's entire business model and its business plan. Murphy's also introduced a membership back in about 2019. And on this right-hand chart right here, we can see that the sales per member per month is continuing to grow from every single cohort from 2019. So once someone becomes a Murphy's member, they tend to stick around and continue spending more as time passes. Murphy's memberships also have an 85% retention rate after 1 year, which is pretty dang strong. Now this next slide shows us that Murphy's is expecting about $1.1 billion in EBITDA for 2024, which is slightly above 2023, but still below 2022 levels. We can also see here in the middle chart how Murphy has used its free cash flow over the past decade. And we can see that they have spent about 48% of cash flows on buying back shares. 40% went to capital expenditures, which is maintaining the business, investing in new stores, and rebuilding existing stores. And then only 11% of cash flows went to acquisitions. So MUSA does not do a lot of acquisitions. Instead, they buy back shares, and a lot of shares. This is actually the number one way that the company spends its profits. And then they also build new stores. So MUSA is not a serial acquirer like alimentation. And this is the main difference between the two businesses. So then my question is, where did Murphy's returns come from? And to answer that question, we have to take a little bit of a deeper look at the company's financials. So let's head over to its income statement now, and I want to take a look at the total revenue throughout history. And we can see that from 2012 to about 2020, actually, MUSA's revenue did decline. But now it has recently spiked, and it is at about $21.3 billion in the trailing 12 months. However, all the way back in 2012, the company did $19.3 billion in revenue. So over the past decade, or really over the past 12 years, MUSA's revenue has only grown by roughly 10%, or it's almost flat over the past decade. So again, where did MUSA's returns come from? Well, we already saw that the company likes to talk about its EBITDA. So if we take a look at the EBITDA that the company has produced, we can see that back in 2012, it was about $284 million, And in the trailing 12 months now, it has been basically 1 billion. So they have roughly 4x'd the EBITDA over the past 12 years, while maintaining basically flat revenue. Now, if a company is increasing its profits on essentially flat revenue, then what that means is it is expanding its profit margins. And right here, we can see that back in 2012, MUSA's EBITDA margin was about 1.5%, and in the trailing 12 months now, it has been 4.7%. So its EBITDA margin has tripled over the past 12 years. And this is how the company has been able to grow its profits over the past 12 years, is all through margin expansion and then a very little amount of revenue growth. Now, if we also head over to the cash flow statement and take a look at its operating cash flow, we can see that it has grown quite a bit over the past 12 years as well. Back in 2012, it was $237 million, and in the trailing 12 months, they have now produced about $770 million. So operating cash flows have also almost tripled over the past 12 years. And this is also because MUSA's operating cash flow margins have been expanding. So let's continue to take a look at the cash flow statement. And one thing that I am noticing here is that MUSA does not have any stock-based compensation. And if you are a viewer of my channel, then you know that I love to see little or no stock-based compensation. So that is a very good thing for me to see on the cash flow statement. Then we can see that in the trailing 12 months, MUSA has had about $340 million of capital expenditures, which means that the company has produced about $431.2 million in free cash flow in the past year. Then my question is, how is the company spending this $431 million? Well, we can see that they spent about $34 million on paying a dividend, and then they bought back roughly $405 million worth of shares. So almost all of the free cash flow, well, actually more than all of the free cash flow, goes to paying dividends and buying back shares. And buying back shares is by far what the company prefers to do. I mean, they spent $406 million on share buybacks and only $34 million on dividends. And if we go and take a look now at MUSA's income statement, and on the income statement, we can see the diluted shares outstanding. Well, back here in 2013, they had 46.7 million shares outstanding, and now they have 21.16 million shares outstanding. So MUSA has reduced its share count by roughly 60% since becoming a public company, through the company buying back shares with its cash flows. Now, if we go and take a look at MUSA's operating cash flow per share, we can see that it was about $5 back in 2012, and in the trailing 12 months now is 36.4. So its operating cash flows per share have 7x'd over the past 12 years. And the reason for this is once again because they have about tripled the operating cash flow and lowered the shares outstanding by 60%. So that combination right there leads to an operating cash flow per share growth of 7x over the past about 12 years. And this really shows the benefit of a company that can buy back a significant amount of its shares, because on a per share basis, there is a significant amount of shareholder value created. And on a per share basis, it can accelerate the profits that the company produces for its shareholders. So now let's go and take a look at MUSA's long-term EBITDA growth. And we can see that over the past 12 years, it has managed to compound its EBITDA at about 11.84% annually, which is a pretty dang strong growth rate on an annual basis. If we also take a look at the shares outstanding, we can see that they have declined by about 7% annually. So now let's take a quick look at MUSA's price to EBITDA historically versus today. The company is currently trading for 10 times EBITDA today, and its long-term historical average has been about 6.5. It's actually trading for an all-time high price to EBITDA currently. So when we take a look at this metric, it is arguable that MUSA is actually quite expensive right now, at least relative to how the market has historically valued this business. We can also see that MUSA was able to buy back so many of its shares throughout history because it was trading for low multiples. And when a business trades for low multiples, it makes stock buybacks much more effective, which is what I write about in my book. However, now that MUSA's multiples have expanded and the stock is more expensive, I don't think that it is going to be able to buy back as many shares on an annual basis and deliver as much value back to its shareholders because the stock price is more expensive now. So to summarize what we have found with MUSA so far, the business saw multiple expansion, margin expansion, profit growth, and bought back 60% of its shares since becoming a publicly traded company. And this led to massive shareholder returns. So now let's take a look at the company's projections and what it is expecting going forward. So right here, we can see that by 2028, the company is projecting to produce about $1.3 billion in EBITDA and have shares of about 15.7 million, which is down from the 19.7 million today. Then MUSA is also saying that it wants to trade for a price to EBITDA of 10 But trading for a multiple of 10 times EBITDA is kind of out of the company's control because they don't control how the market values the business. I mean, if its growth slows down or if something happens to the business, then, you can't really control what your stock is going to trade for. So this is an interesting piece of information to put into their slide because they're basically saying, we want our business to trade for 10 times EBITDA, but they don't actually have any control over that. So is it even worth putting into the slide? Maybe not, in my opinion. But anyways, moving on, when we do the calculations, MUSA is expecting its share count to decline by 5.5% annually out to 2028. It is also projecting its EBITDA to grow by about 4.3% annually out to 2028 as well. Now, what this ultimately means is that MUSA is actually projecting its EBITDA growth to slow down quite significantly. Because remember, since its IPO, it was growing its EBITDA by roughly 12% on an annual basis. So only 4% annual growth over the next 4 years is actually a pretty significant decline to the company's overall profit growth. And what's also interesting is with the company trading for those higher multiples, it's going to have to take on debt to probably hit this 5.5% share buybacks on an annual basis as well. Because the company, when it trades for a higher multiple, again, it's just not able to buy back as many shares as it did historically. So now let's talk about MUSA's price today, and if I believe that the stock can continue to outperform the S&P 500 and compound so massively going forward. And in my opinion, I actually think that there is a less likelihood that MUSA's stock is going to replicate its historical returns going forward. And the reasons for this are the company is simply trading for a significantly higher price ratio today, while it is also projecting a slowdown to its overall EBITDA growth going forward. So basically the company is trading for an all-time high price to EBITDA, while it's also seeing a deceleration of its growth. And those two things don't really make sense to me. And it ultimately leads me to believe that MUSA's price to EBITDA is probably going to come back down to its historical averages over the next few years when the market realizes that, hey, this business is not actually growing in line with how it did historically. Because it does make sense for the market to value a business higher if it is seeing an acceleration to its growth. But when a business is seeing a deceleration to its growth, it typically will see its multiples contract, but MUSA is currently seeing the opposite. It is seeing its multiples expand while the overall business's growth is decelerating, and I don't like those two things. Additionally, we saw that MUSA spent 48% of its operating cash flows towards share buybacks since becoming a publicly traded business, and this made sense while the business was trading for very low price multiples because it could deliver a return of about 7 to 8% on an annual basis to its shareholders. And that created a lot of wealth for their shareholders. However, again, with the business trading for a 10 price to EBITDA today, its buybacks are not going to be as effective, and that is not going to have as much of an impact on the overall share price growth going forward. So that alone also suggests that the company is not going to produce similar returns going forward from here, especially if the price to EBITDA does not come down. And what we can do here is use Stock Unlock's discounted cash flow calculator and MUSA's own EBITDA projections out to 2028 to find out its fair value today. So we're going to use the EBITDA metrics with that 5% annual EBITDA growth rate, 5.5% share buybacks, 5% dividend growth rate, which is in line with the EBITDA, and an 8 price to EBITDA. And when we enter in these metrics, we get a compounded annual growth rate of only 6.7% and a fair value of $411, which is 14% below where the stock is currently trading. So based on MUSA's own estimates out to 2028, the company should not deliver market-beating returns going forward. And I am pricing in a little bit of a multiple contraction for the reasons that I did say earlier. With the company's growth decelerating, I do think that it does deserve a multiple contraction going forward. So then the question becomes, is MUSA a more attractive business than Alimentation, which is the stock that I have in my portfolio and is in basically the exact same industry of convenience stores as MUSA? And what we can do is compare the fundamentals of these two businesses. And here we can see that ATD is trading for a price to EBITDA of about 9.26, and again, MUSA is at 10 right now. So MUSA is actually trading for a higher price multiple than Alimentation today. And we can see that throughout history, Alimentation has traded for a higher price ratio, but now this has switched recently, and MUSA is now more expensive on a price to EBITDA basis than Alimentation. If we also take a look at these two businesses' long-term EBITDA growth, we can see that Alimentation has compounded its EBITDA at about 15% annually versus MUSA's 11.8%. So at least historically, Alimentation has actually compounded its profits at a faster rate as well. Now, what's also interesting is Alimentation is projecting about $10 billion in EBITDA by 2028. which does work out to about an 11.7% annual growth rate to the company's overall EBITDA over the next couple of years here. So what we can do is head back over to our discounted cash flow calculator and enter in these EBITDA metrics for Alimentation. So we have 11.7% annual growth, which is the company's own projections, 3% annual buybacks, which is the company's 5-year average buyback rate, and 20% annual dividend growth, which is the company's historical average dividend growth rate as well. Then I am entering in the same price to EBITDA of A tier, and if Alimentation can hit all of these metrics, then it can produce returns of about 12.4% on an annual basis going forward, and its fair value is about 11.6% above where the stock is currently trading. So based on Alimentation's own projections, it can deliver market-beating returns if it does hit them, whereas if MUSA hits its own projections, then it will only deliver about 6.7% annual returns going forward, which are not market-beating returns. And I do believe that Alimentation can continue to grow at this rapid of a growth rate because it is a serial acquirer, and it doesn't spend as much of its free cash flow buying back shares or investing in building new stores. What it does instead is it buys extremely cheap convenience stores around the world, and it gets them at a significant discount to what it believes fair value is. So these two business models I think are quite different, but in my opinion, Alimentation's is much more scalable, and it is how the company has been able to scale much more rapidly at a larger rate as well, like at a larger base as well, I mean. So I do think that ATD is the superior stock, and that is why this one is remaining in my portfolio, and I'm not selling it to invest in MUSA. And how I came to this conclusion is really by taking a look at where did MUSA's historical returns come from, and how did that company allocate its capital to create shareholder wealth. And historically, it has created a massive amount of shareholder wealth. But when you take a look at that strategy going forward now, I don't think that it will produce as much returns because it seems like its margin expansion has kind of hit its limit, and now its overall EBITDA growth is going to be matched by the revenue growth because, again, they don't have that margin expansion tailwind. They also are trading for a higher price now, so once again, the buybacks are not going to be as effective and create as much shareholder wealth. So the two main reasons of how that stock has produced shareholder returns are kind of not there anymore, or at least they're not as effective as they were historically. Whereas when I take a look at Alimentation, everything seems like business as usual. The company can continue to acquire undervalued convenience stores, which is how the business has expanded, and it does have a long runway to continue doing so. So when I take a look at Alimentation's long-term growth and its long-term runway, I think that it can continue to compound at around 10 to 15% going forward, and it is trading for what I believe is an attractive price today. And for those reasons, I am maintaining ATD in my portfolio, and I am not swapping it for MUSA, and I'm not interested in MUSA stock today. And to summarize all of that, it came down to really trying to understand where did the historical returns of these stocks come from, and can those things be maintained going forward. With MUSA, I don't think that they can really, and with ATD, I do believe that they can be maintained. So for those reasons, I'm going to continue to hold ATD. And overall, I think that MUSA was an incredible stock to own historically, but at its current price and with the company's business strategy and its capital allocation strategy, I actually don't think that it is a very attractive stock today, especially while it is trading at all-time high price multiples and projecting less growth going forward. It does make for a really great case study though, so I thought that it would make for an interesting video. And if you want to learn more about how I do my stock analysis and how I think about where historical returns have come from, then seriously, you should check out my book, The Fundamentals of Investing. I dive into all of this stuff. I explain balance sheets, cash flow statements, and how you can really learn all of this stuff in plain English as well. It is really a great book, and it has dozens of positive reviews on Amazon, so I would recommend going and reading the reviews for yourself because those are genuine reviews from my readers. So if you are someone who is looking to learn more about stock analysis and the stock market in general, and how stocks actually create shareholder value, then seriously, I would recommend going and checking out my book, The Fundamentals of Investing. But that is going to wrap up the video for today, everyone. And if you did enjoy this video, then please leave a like on it, as it does really help out my channel, and I really appreciate it. And if you're new here, then please consider subscribing to my channel as well if you want to see more stock market related content like this. But with that being said, thank you all again so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.